Mm, uh, mic test. Hello. Yes. We'll be starting in about 3 minutes. I'll just speak a little about what this channel is about. Introduction. As usual. So right now, what I'm doing is going through questions from a topical exercise for GCE O levels. This is regarding accounting, so principle of accounts. And currently we're on question 6. Unfortunately, my student isn't joining me today, so this will be um, just a teaching session. But I will go through the thought process behind solving the question. So hopefully, if you guys can follow along, and if you're watching the VOD back on YouTube or Twitch, yeah, feel free to actually pause the VOD and do your own practice. Most of the time I'll be asking for recaps, so I'll giving you time to um, really just recall what you have learned before and try to apply what you have learned. So through this repetition, I hope that you guys get to remember certain concepts and just not blindly memorize. It's more important that you know the rationale of it so that in the future, when things get more complicated, you have sufficient foundation to actually, you know, solve it on the spot. Yes. Uh, and those of you who, happen to chance upon this video, how it goes is usually like this. I just show the questions, the screenshot of questions on my notes, and then I solve it. And then I'll post both the VOD as well as the notes on well, most of it will be on YouTube. The notes will definitely be on YouTube. Linktree kind of thing. Uh, just started it. Not sure how this will go, but yeah, I'm always trying to improve on the way I deliver the lessons. And if you have any questions or if you don't understand something, number one, it's perfectly fine to not understand uh certain explanations that I give, because everyone understands things differently. I actually try to explain from multiple angles if I can. So if you don't understand, just let me know in the YouTube comments, or better yet, let me know in the live chat so I can actually clarify it immediately. If not, I'll have to make a supplementary video for alternative explanation. And yeah, speaking of supplementary videos, usually I'll make those to explain certain accounting principles or treatment that I think is useful to know. Again, I am not a professional teacher, nor am I a professional accountant. So, very high chance I'll get some things wrong, and I will usually clarify them in the supplementary videos as well. So, yeah, I mean, time now is 8 o'clock. Without further ado, I will start. Uh, right, so we're actually on question 6 right now. Uh, actually, alright, let's zoom in and look at the question real quick. Right, I think you guys can, yeah, you guys can see it. Okay, so let's just read the question, right? Oh. And let me use a different color for the question. I think green. No, green doesn't look too. I'll use dark blue. So inventory on 1st of August is 70 necklaces. Cost is 385, right? And then the items below are actually events that happen throughout the month of August, right? So on the 8th, you bought 28 necklaces on credit, and the cost is 182, right? On the 10th, you bought another 30 on credit, and the cost is 219. 15th, you bought 20 necklaces for cash, and it cost 150. On the 17th, you actually sold 128 necklaces. 29th, you bought 15 necklaces on credit, and it cost 108 total. So The next question would be calculate the cost of sales of necklaces on 17 August 2024. Now, for those of you who remember um, the content that I've gone through or you've watched it, uh, in the video I did say, you know, two or three different accounting treatments that are commonly used when it comes to cost of sales valuation. In this question, they didn't say, so I'm gonna make this assumption that it is first in, first out. I could make a supplementary video to illustrate the other two methods as well if you guys want, and if I have time. Unfortunately, I am quite busy nowadays, but uh, we shall see. We shall see. Right. Because I do owe you guys one more supplementary video that I haven't started making yet. Oh, alright. It's okay. So I'm gonna assume uh first in, first out, FIFO. Okay. Um so let's actually break down this question, okay? Firstly, I'd like to draw a timeline. So let me zoom out a bit so I have more space to work with here. Right. Okay. So let's look at the timeline, alright? I'm gonna draw it top down. So 1st of August, right? You have 70 necklaces. Times a certain amount, you get 385 total cost, right? So up here is cost, right? This is the unit price, right? And then up here is the quantity. Okay, pardon my lack of organization here, but hopefully you guys can still see. Alright, so I'm just gonna calculate the unit price real quick. Sometimes it's not mandatory, but it's best if you just do the whole thing, right? So unit price is 385 divided by 70, which is 5.5, right? And then on the 10th, so let's draw a line to show that it's a new day, right? On the 10th, you bought 30, so we have 70 times 5.5 up here. You have not sold it yet, so it still stays inside your warehouse, inside your room, wherever you're storing it, right? And you bought 28 necklaces on the 8th of August. Whoops, my bad. Let me just correct this date real quick. Is this the right? Yeah, okay, 8th of August, right? Then, times a certain amount equals to 182, right? So to get the unit cost again, the unit price, 182 divided by 28 is 6.5. Okay. And then we continue, looking at it, 10th of August. So what I am doing right now is rewriting whatever that happened before because these items still stay within your warehouse as of now, right? So you got to keep track of what you have in your warehouse so that first in, first out can be applied properly. Okay. This is not as relevant for weighted average for a very specific reason. Um, I've explained it in a supplementary video, so if possible, you guys can check that out. Uh, if not, I could do another different kind of explanation on it, but not in this lesson. So, kind of like on a request basis at this point. But yeah. Alright, so it's 30 necklaces at a total cost of 219, right? So, get the unit price, 219 divided by 30, you get $7.30, right? And then you have one on the 15th of August, right? You know what? Instead of writing everything out, I'm just gonna do the lazy man's way. Okay, never mind. I think I'll waste more time trying to find out a way to do this. So I'm gonna do this for now. Just write it out. 182 30 times 7.3 219 Let me scroll down a bit. Okay. Right. So on the 15th, you bought 20 necklaces for cash, and it costs 150. Right. So each one would be 7.5. So it's 150 divided by 20. So yep, 7.5. And then you finally make a sale. Hooray. 17th of August, you made a sale. Right. So whenever you make a sale, right, the first thing you think of is what measurement method I'm using. So for example, am I using FIFO? Am I using LIFO, last in first out? Am I using weighted average? Or am I using something else that uh you know is not the other three, but is still accepted as a accounting method? So you ask yourself that first, right? And then you figure out the rules of it as well. So for example, what we're using now, first in, first out, meaning whatever you buy first, you sell first. So I've deliberately written down the the order I bought the goods. So the ones on top is the um things that I bought first, right? So we look at the total number sold, which is 128. So we can make a note somewhere like 128 is the magical number. Right. So 128 is greater than 70, right? So uh you sell the whole batch. Okay. And then after that you're down to 58. 128 minus 70. So you're down to 58. And then you see the second batch, 28, which is still less than 58, right? So you sell the whole batch. And now you're down to 30, right? And then you see the third batch. And it's just nice. You have 30 and you sold 30, right? So 0 times 7.3 equals to 0. Okay, so this 0 means that, yeah, you've already sold it. It no longer belongs in your warehouse. And all you're left with is 20 times 7.5, which is 150. Okay, that is another one. And we can go to 29th of August, where you bought 15 on credit. Right, let me just get this in frame. So 29th, you bought 15 on credit. So I mean 20 times 7.5, 150, then you bought 15 on credit for 108. Okay, so you just calculate the unit price real quick. 108 divided by 15 equals to 7.2. Okay, do know that this method is a little slow and tedious. So if you're in an exam, you're rushed for time, right? You either memorize a faster method, basically you write an equation, or you draw this out. If you're the type that cannot visualize a scenario properly, I really suggest you draw out the table instead, because it's better to get some method marks than to visualize wrongly and get no marks at all. Okay? So it's up to you. Really, it's also up to you. If you feel confident in your own visualization of what happened, then by all means do the faster method so you can get more questions done. Right? But if you're already struggling, I suggest in practice you draw it out and try to maybe use the equation, but it might not work out. But yeah. Right, so this is actually what happened, right? I've drawn out the entire all that happened so far. So we can actually do question A actually before that. So cost of sales, right? You have 128 that you sold total, right? So what did you actually sell? So let's look at the 15th. Why? Because it's right before the sale, and there were no other purchases before the 17th, which is when the sale occurred, right? So 15th is the last, I would say, like backup data they can rely on, right? So what did you actually sell? Well, you compare it with the 17th aftermath, right? 0, 0, 0, and nothing was touched at the bottom. So you sold the first 3 batches. So your answer for A would just be 385 plus 182 plus 219. Oh, that's off screen. Okay, that should be fine. And just punch in the numbers on the calculator. And you get 786. And that's your answer for A, right? Next, calculate the value of ending inventory at 31st August. So, you will look at the most recent date before 31st August, which is 29th, right? So, I mean, they didn't say you bought or sold anything after the 29th. So, what do? You just take 150 plus 108, which is 258. And that's your answer for B, right? Maybe I should add the dollar sign. There you go. All right, C, state the double entry. Okay, so this is a bit complicated, but let's try to rationalize it. Go through it step by step, right? So the question is asking, how do you record purchase of inventory on credit? So let's break it down word by word, right? Purchase means you spend something to get something, right? Purchase of inventory means you spent either money or you took a loan or something to get inventory, right? So let's look at what inventory is. Okay. We use the accounting equation to classify. Asset equals to liability plus equity. Okay. Assets and liabilities have two very important criteria, right? The first one is history. The second one is probable future economic benefits. Right, four very interesting words. So let's go through the first one because it's more straightforward. History just means you got it somewhere, somehow, right? That's it. The second is you intend to, and it's likely that you're able to, exchange these items for, okay, sorry, benefits or loss, like, right? So it's very likely, not very, it is likely that you will have to exchange actual like cash or, you know, economic benefits. So things like, I mean, the most straightforward one would be cash. Maybe it could be other things like your other assets, maybe that you could exchange other items for it as well. Point being, you either gain something or lose something in the future, not now, right? So, and then E is just not asset or liability. You just put it under E, right? Uh, so let's look at inventory, right? Does it have a history? Well, if you think about it, right? I exchanged, for example, like you just bought lunch or something. Uh, or you bought okay, let's say what you're trading. Say you're trading drinks or like canned drinks, yes, canned drinks, right? What you do is you spend some money to buy a lot of canned drinks, right? So some way, somehow, you bought the drinks, right? So it does have history because it came from somewhere. You can't just magically have drinks appear. So that is one, and it's checked. Number two, well, usually when you buy something with the intention to sell it, you don't intend to sell it with a loss, right? You want to sell it for at least some profit so you can keep the business going, right? And provided that, you're in a market that is very, very uh rewarding. I wouldn't say very rewarding, you just say like market that can sustain itself. Then high chance, yes, you can sell those whatever items at a profit, which is what we can call economic benefits, right? So inventory does check the second box as well. So, conclusion being, inventory is an asset. Okay. So check and then say benefits. Because you're not gonna make a loss from selling an item. That is just not a good business. That's just not good business. uh, and if that's happening to you right now, I'm so sorry. Hopefully it goes, better soon. But okay, so that is, inventory settled. So asset, what does that mean when, uh, you know, for debited and credited, right? For this, we look at the accounting equation again. A equals to L plus E. Okay, there are two ways I use personally to determine which one to debit and which one to credit. I like the credit card analogy more because it literally is what it literally describes what it is, right? So a credit card, if for those of you who do not know what that means, is you want to buy something on using a credit card. What happens is that your bank that issued the credit card will pay the shop first, right? Then after a while you pay back the bank, usually at the end of the month, right? So if you think about it logically, right? What is a credit card? What happens when you spend on a credit card? Does it have a history? Yes, because you know you bought something using the credit card. So the amount in your credit card came from somewhere, right? And the second is you gotta pay them back in the future, meaning you have a probable, if not compulsory, future economic loss, right? So a credit card actually checks the boxes for one and two, but it's instead of a benefit, it's a loss. So credit card is actually a liability, right? And then because it has credit in the name, right? When your liability increases, you credit it in order to increase it. Okay? Debit and credit are just plus and minus. But when used on different accounts, it means different things. So for example, okay, anything on this equal sign, right? This equal sign that I'm pointing to right now. Anything on the opposite side of it would mean the opposite effect. So when an asset increases and you want to record that increase, you debit it in order to increase it. Okay? And for equity, because it's on the same side as liability, when you want to increase equity, you credit it to increase. Okay? Don't think of debit and credit as a a separate thing. It is just a way for us to say it increased or it decreased, right? It is a tool, merely a tool. I'll say it could be a verb if you're using English as an analogy. Yeah. So now we know that what to debit and when something increases, what do you debit it or do you credit it? So now let's look at inventory, right? We know that inventory is an asset. Okay. And because your inventory increased, right? You debit. So let's go down a bit more. So you debit inventory. By how much? We don't know because the question didn't say. But you know you debit inventory and X amount. I'll use XX. Okay, so that is one side of it done, right? And the beauty of accounting double entry is that your total amount of debit should equals to the total amount of credit because matter cannot be created nor destroyed. Physics is still applicable here. Yeah. So let's go back. We see that we bought something on credit. So what does that mean when you buy something on credit? It just means you told the shop, hey, can I receive these items first and then I'll pay you back later? That's it. That's literally what buying on credit means. I'll get my item first, I'll pay you later. So let's see. I mean, it sounds exactly the same as a credit card, right? The bank buys for you first, and then you pay them back later, right? So what we call trade payables, and it's a liability. Okay, trade payables. Trade refers to the business. So trade payables are payables that occur in the course of the business. What do I mean by that? Well, say that you are, same thing, buying and selling canned drinks, right? If you bought something else, for example, you bought a car on credit, usually you don't put it under your trade payables because that is not what you do as a business. You don't buy and sell cars, you buy and sell canned drinks, right? So usually you classify trade payables as such, when you buy canned drinks on credit, you put it under trade payables. If it's not what you're usually trading, you don't put it under trade payables. You can put it under accounts payable, which is a more generalized account, or you put it under other payables. That could work as well, right? But for now, your trade payables, right? Payables just mean you gotta pay someone back in the future, right? Payables. So your payables increased. Why? Because you took a loan, basically. Essentially, you took a loan from the shop, right? So you increased, and therefore you credit it because it's a liability, right? The accounting equation up here. Maybe I'll use a different color. Let's use red. Right. So I'm just gonna point to the counting equation. So you can refer to this in the future as well. So trade payables. Anything else, right? You look at the question. Because sometimes you can have multiple accounts debited and credited at the same time. As long as the sum is the same, you can do essentially unlimited accounts. Not recommended, but you could, right? So, I mean, just looking at the question, you record purchase of inventory on credit. I don't think it suggests anything else. If it's on credit and cash, then you gotta add one more line. What do I mean by that? So, okay, so this is one scenario, right? If they say and cash, you gotta split. You gotta split it. So instead of XX on trade payables, you have YY and ZZ on payables and cash. And YY plus ZZ equals to XX. Right, so what I wrote in red is a hypothetical scenario. When if the question says on credit and cash, okay, the red color ones are hypothetical scenarios here. So yeah, that is actually the end of the question, right? Very short and very simple. Maybe let's go through some recap. If you're watching this periodically whenever it comes out, we can go through some important concepts. So the very first and important item we need to consider is oh, I did not know the pen does this. Okay, interesting. Okay, let me change the color. Can use orange? No, let's not use orange. Or purple. I think it's okay. Yeah, okay. The color is fine. So we use purple. How do you know, what's your cost of inventory? Oh, sorry, how do I phrase this properly? How do you value your inventory? Right. You can use first in, first out, FIFO, weighted average. Okay. and last in, first out. Okay, so let's do a quick exercise, right? If you're watching this VOD back, then it'll be very simple. You can just pause the video. I want you to explain in your own words what is FIFO, what is weighted average, and what is LIFO, and which accounting standards allow which of the three, right? So I'm just gonna wait 5 seconds on stream, but feel free to pause it. Okay, right. So FIFO means first in, first out, right? I've explained it just now, right? First in, first out means whatever you buy first, you sell first. So buy first equals to sell first, right? LIFO is the exact opposite, where you buy either buy first, sell last, or you buy last, sell first. Buy last, sell first is more intuitive to me, but if it doesn't work for you, you can use the other one. Weighted average is interesting. I like to use either gold bars or gold coins or things that are very like identical, and also well, their value remains somewhat constant throughout time. So say you have a bunch of coins, right? I'm just gonna use coins. Okay. You have a pile of coins somewhere, and suddenly you threw in a coin, right, into the pile. Let me just circle this, right? So you threw a coin into the pile. Provided it's the same coin as the other coins, do you really care about when it was made or when it was added to the pile? In fact, can you even determine? If you have a pile of like 1,000 coins, do you still, and you throw in one coin a day, are you really going to separate it into 1,000 days worth of coins when its value is, somewhat similar and it looks identical? It's not practical to do so. It is possible, but you're probably gonna go crazy trying to account for this, right? So, I mean, we are humans too as accountants. So what we do is we just make an assumption, right? Just say, yeah, they look the same. Let's just assume that their values are just the average, right? But not just any average, weighted average. So what does that mean? It just means that if you have a lot of coins at the start, the value is gonna lean towards the majority, right? Whatever you add in will still have an impact, but the majority will still have the final say in like the amount of movement. They're gonna resist more, basically. They're gonna resist the change more. I've illustrated it in the supplementary video before, but this is how I can put into words, which is a bit complicated and difficult to visualize. So please, if you have time and if you're willing to learn, go and watch the supplementary video after this. I hope I've explained it well enough there. If not, come back to me. I'll find another explanation for you. Okay? So these are the three methods. And, okay, when I refer to accounting standards, I'm referring to IFRS, or for my friend, student, SFRS. They are similar in a lot of sense. So I'm just gonna use them interchangeably for now. FIFO, LIFO, and weighted average. I'm just gonna call it WA for now. I'm gonna draw a table. And then we have GAAP. GAAP is mainly for the US, so friends in the US. Okay, so FIFO and weighted average are allowed under IFRS/SFRS, and LIFO is not. GAAP accepts all three. Okay. Okay. And then now that we determine how, which method we use to value, here comes the rules of valuing. So, first you find the cost, right? Cost meaning what you bought it at. The second is NRV, net realizable value. Okay. So cost is how much you bought it at. Net realizable value is usually selling price minus a very specific type of cost. Okay, let's see. The most common will be repair cost, right? So what does that mean? Say you broke an item. So for example, you are selling maybe laptops, right? You accidentally dropped one of the laptops and it got damaged, right? Naturally, you don't want to throw it away because it's like a few $1,000s worth of inventory, right? So what you can do is you repair it. You spend some money to repair, and then you set it at a slightly lower price, right? If you want to be an honest person, you say, yeah, this is a refurbished item. You sell it at a slightly lower price. You still earn something instead of scrapping the entire item, right? So that amount, what you sold it at, usually at a lower price, minus the amount it cost to bring that item back to a sellable state, usually by repairing. It could be other things as well. That is NRV, net realizable value, right? So now you know the two, you take the lower of the two. Why lower? This is what we call the prudence theory. Okay. Basically, it just in plain terms is you think about the worst probable scenario, right? And you assume it to have happened and you recognize it immediately. So even if a bad thing hasn't happened, if it's likely to happen, you try to quantify the damage and then you recognize it as a loss immediately. That is the prudence theory. Why do we do that? So, the opposite is not logical. Why? Because that means you can literally write any number in accounting and say, yeah, look, we believe that our stocks will rise by 1,000,000%. Maybe 1,000,000,000%, we're gonna win. Uh, yeah, and then there's no point in doing accounting because everyone's gonna be able to do that. So we can't allow that, right? Then why is prudence allowed? Instead of like if the optimistic view is not allowed, why is this pessimistic view, allowed and sometimes encouraged? It's not always, right? The answer is actually pretty straightforward. It's really an experience kind of thing. So for those of you who have experienced it or lived long enough to hear about it, all those economic downturns, right? Everyone actually loses, kind of. So, in order for businesses to really say, yeah, can I actually continue, like, running my business in times of in bad times, right? In good times, it's fine. Like, everyone is kind of winning, but in bad times, I want to not lose so hard. So, in order to do that, you take the probable worst case scenario and you factor it in when you do your calculation. So it's kind of like a prediction. In accounting, it's called estimation, but I like to think of it as a prediction. So say, yeah, you know what? I think there's like a 70% chance of this item just being useless, not sellable. So you quantify it, right? You have a 70% times the amount. And you immediately recognize it as a loss because, well, I mean, it is very likely. 70% is quite high chance. Right, so this is what prudence advocates for. However, it does come into conflict with other accounting principles that I have not gone through yet, so I will not open that can of worms. But just know that for now, this is the reason why you value inventory at the lower of cost and net realizable value. Okay, you recognize the loss that is very likely to occur in the future first. You recognize it first. That if it doesn't happen, you can be happy and you can reverse it. So usually the way we counter this is it's reversible. So when times improve, you can just say this did not happen, thankfully, and you recognize the gain back, but you don't recognize more than whatever you know you have lost before. So basically, take the pessimistic approach first, reconcile it later, right? That is what this sort of theory advocates for, and it is what's in the IFRS at least. So yeah, that is one recap done. To be honest, I don't want to do too many because that'll involve me saying a lot of explanation. I've already gone through a lot here, using a lot of real life examples, trying to let you guys understand this. But if you don't, once again, it is perfectly fine. Accounting is not easy to pick up. Once you have, done it many times, then these sort of things become kind of like second nature. But if you're just starting out, it is really difficult. I will admit I went through the same phase, right? So this is why I want to use as many different ways of explaining something as possible, so that, as many people gets it as possible, trying to help out uh help out my viewers, help out my friends, yeah, who's studying a bit. So yeah, that is actually the end of this lesson. Once again, I would like to say, firstly, thank you very much if you're watching this back or if you're watching the stream, right? It really means a lot to me. Uh, and secondly, I do have channels that you can reach out if you have any questions related to accounting, related to my explanations. If you want me to explain more, if you want me to explain it a different way, a few ways you can do that. Okay. First one is the easiest for both of us. Uh, you just type it in a live chat. I go live for now every Wednesday and Friday night. Or yeah, the actual timing will be 12 p.m. UTC, right? For me it's nighttime, so right. Wednesday and Friday. The next best way is to drop a comment on YouTube, like under my lesson, saying, "Oh hey, for this lesson, you could leave a timestamp, or you could just refer to like my explanation. Say, for example, oh yeah, the weighted average explanation just now, I don't quite get it. Right? You could just say that. Um, if you want to be more specific, you can say, uh, like which parts you don't understand, right? And then I'll try to either type out a response, but I usually don't like to do that because it limits me in a lot of ways. Or I just make a short video to explain it in further detail, and hopefully, you get it. If not, we can try and error it. Just really explain until you get it. That's like what I aim to do here on this channel, right? And the last one would be on a form. So I have an anonymous form that you could fill out. You could also attach like photos and stuff. Um, and I do read them. So yeah. The only issue is sometimes I need to plan a lesson around it. So it might take a little while more, right? So honestly, the best approach is just type in the live chat. I do read through everything. So yeah, to be honest, that is all I want to say. Do look out for the supplementary video for the previous lesson. I have not yet started on it. I am busy. To be honest, the only reason why I like doing this is really, well, I like doing it. That's the only reason why I'm doing this. Um, so yeah, if you really find this useful, let me know. Say, oh yeah, I like this way of explanation, so I can do more of it. in the future. If you don't like it, just say as well. Say like, oh yeah, this explanation is a little complex. I don't quite understand this way of thinking, and I'll try to help you out with that by coming up with another explanation. Once again, because people learn things differently, and I really just want to help as many people as possible. So I'm gonna leave like alternative explanations if people ask. If not, unfortunately, I have to assume that people get it, right? And one more thing, it doesn't matter when I posted the video. If you find a very old video of mine, uh, feel free to leave a comment either on that video or like my newer videos. I don't think it really matters too much. I can still see them. And yeah, just make the proper references. Like say this video on this date or the video title, so that I can have something to refer to answer your question, right? And yeah, to be honest, that's all I really want to say. Once again, thank you very much uh for watching the VOD, watching the stream. I hope I've helped in your learning in any way. If you've learned something, great. That's all I want. Just learning something out of half an hour, 40 minutes of video. Yeah, and I'll see you guys in the future. Bye bye. Take care. Yeah.